You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Last week, we looked at a Boeing time spread, and it was one of those things where we talked about a long straddle, and the long straddle worked fine as a paper trade. And then we said, well, let's rinse and repeat. And we really emphasize that it depends. On Options Playbook Radio, we're not talking about, oh, we like this stock, we dislike that stock, we're bullish, we're bearish. We look more at what are pricing situations that this specific strategy might be better than that specific strategy. And when we were talking about the long straddle, we specifically wanted to avoid earnings because there was enough juice in Boeing as it was, and there's enough news, and the news just kind of sideswipes you in Boeing these days, and that's normally not the case. So that's when a long straddle might apply, and we did get to move, and that trade worked out fine. So we said now Boeing is going to be announcing earnings, and they're going to be announcing earnings on the 24th. So we looked at a time spread, and what we did, we did it on the call side, and we did it basically at the money. We looked at either doing it on the call side or on the put side if you wanted to be a little bit bearish. We did mention it in last week's call. But now what has happened is we put on the trade, and we sold a call, bought another call right around where the stock was at, and since that time, the stock has dropped about 20 points, and we were right to protect ourselves going into earnings by buying a call and selling a call against it, because implied volatility is going up on the one that we bought, it's going down on the one that we sold, and we're just going to let it play out another week. So the trade is down a tad, but then again, if we hadn't sold the short-term call against our longer-term call, we'd be down more. So we're going to let the trade ride another week, and we're going to look at another earnings trade this week. We are taping Options Playbook Radio right now. It is the 1st of July. The market is open, and we're going to stick with another earnings trade. And I'm trying to look into strategies that I don't talk about very much, and a lot of times we don't talk about buying call options or buying put options around an earnings forecast. And I noted the other day that BBBY, Bed Bath & Beyond, is going to be announcing earnings on the 10th. And we're going to have the holiday in the middle here. And Bed Bath & Beyond has been an interesting stock over, to say the least, over the last year. We've seen that stock trade as high as $20, and actually the high for the year is $21.45, and we've seen it trade as low as $10.46, and right now it's at $11.31. So to say it has volatility is definitely, it's almost, the chart is a perfect to define volatility. We got a lot of large gaps inside the chart, gap open, gap down, gap open, and this is all within the last year. So one of the things that intrigues me, once again, I have no real opinion on Bed Bath & Beyond, but I do like the fact that it's $11 stock and you're going into earnings. So I don't mind buying long calls or buying long puts to be bearish, long calls to be bullish going into earnings. And you can make your judgment on that. But on Options Playbook Radio, we're just here to learn. It's not meant to be a recommendation. And this would be one time going into earnings on this stock with these conditions where I wouldn't mind taking a shot, because the premium for the option contracts, the implied volatilities are still fairly high, but it's such a low price stock that it offsets a lot of that high volatility. So if I'm going to look to the call side, and the main reason why I'm going to look on the call side is that there was a big trade that went off in the July 19th expiration. Now remember, July 10th is when earnings is going to be announced, and I'm not quite sure if it was a buy or a sell. There's a lot of open interest on that strike, and there's a few strikes in here that have a ton of open interest. I don't put a lot of weight behind it, but here's what's up. I would rather see volume and open interest in the one that I'm trading, the option contract that I'm picking, than not see it. If anything, it just adds the chances of getting out of your position at a fair price are just higher if you have volume and you have open interest. The markets have a tendency to be tighter, and this isn't this isn't a very extremely popular option trading vehicle. Volumes aren't bad, but the stock is fairly low. So a lot of times the stock will just take a lot of the volume away from the options market when the stock price is where it is. Right now it's at 11.30. It's down 30 cents, but the markets are moving. Okay, so this week's paper trade is going to be fairly simple. I'm going to look at the call side because of what I mentioned. I'm going to go out a little bit further in time, and if I'm ever buying options around earnings, I'm going to go in the money. I'm going to look at with the stock at 11.30 right now, and we'll just call it 11.30 because the market's moving. We're not going to keep adjusting our quote based off of the market move. So the market right now is at $11.30 in BBBY, Bed Bath & Beyond, and we're going to look to buy the July 19th expiration. It has 18 days away, and the strike that we're going to be on is the 10-strike call. Open interest in that 10-strike call is 758, and we see a volume of 500 today. So it'll be interesting to see if open interest goes up tomorrow or if it goes down. That will give you some type of hint as to if these were opening or closing positions. Doesn't always tell you, though, exactly if they were intended to be bought or intended to be sold. But the bottom line is we see some volume in this. We see an option contract where we're getting a 75 delta. We're going to pay about 40 cents worth of time premium on this. And the total cost of this call option is $1.77. And that's what I mean by we're getting decent intrinsic value. We're not paying an insane amount of time premium. And yes, that's going to be susceptible to volatility. But if you want a fairly cheap shot on a decent in-the-money option contract, I would look at doing this on the call side. Now, if you turn around and you're bearish, I'd like to stay in that same expiration, 18 days away, the July 19th expiration, and I would look for the same type of delta. The volume and open interest on the strike that I'm going to mention isn't quite as good as it is on the call side, but I would be looking at the 13-strike put if you wanted to be bearish. It's a little bit more expensive. Volatility is just a little bit higher. Open interest is 873, and only 9 contracts have traded today, but that option contract is trading for $2. So if you look at Bed Bath & Beyond and you look at the chart and you see the gap openings, the gaps down, the gaps up, the true volatility of the stock, there's potential here that I wouldn't want to cap by doing a spread. and we're going to give it the time for the thing to play out. We're not going to buy the July 12th expiration that only has 11 days. We're going to give ourselves an extra week, see if we can get some of that volatility back in the stock. And the news is good or bad. You just got to flip a coin and think if you're going to be bullish or bearish, or do whatever you do to decide if it's bullish or bearish. But when we look at a chart that shows us the type of movement where over the last year, it's been as high as 20. It's gone from 20 down to 10, up to 20, down to 10, up to 15, down to 13, back up to 20 again, and now we're at 1130. So we're just seeing some massive volatility, and I think it's fairly inexpensive, and mainly because of the low price stock. So don't talk very much about just buying puts or just buying calls around earnings, but then again, that's what Options Playbook Radio is all about, to look at scenarios and say, well, gee, this trade might be feasible because we have an $11.30 stock in this instance. All right. Well, that's kind of short and sweet. We will be away for the holidays, but we'll be back next week. So this trade will play itself out. I won't be able to watch much of it. I will be on vacation. I will be on a lake somewhere. And I will see you same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.